A recovery in the U.S. has helped to boost the global economy, but uncertainty still remains about the strength of the revival and when and at what pace the U.S. Federal Reserve will hike interest rates. We have seen some dovish views from the U.S. Federal Reserve on the outlook for interest rates, and they've definitely been contributing to the rally that we have seen in the emerging market space. Well, we're going to be talking a little bit more about that, and joining us now to take us through this conversation, we've got Geoff Blount, Managing Director of BayHill Capital, and Colen Garrow, Economist at Lefika Securities. Gentlemen, thank you so much for joining me this afternoon. Geoff, let me start with you. Yesterday, all eyes were set to be on the European Central Bank and commentary out of that. Next week, we've got the U.S. Federal Reserve and the Bank of Japan. So as South Africans, we are interested in these events and commentary. Why?
That's a great question. We're interested in them because they influence the way capital moves around the world. So if the US raises rates, or unlikely, but let's say the Europeans or the Japanese raise rates, then capital will go to where you can get a higher yield. And the main focus is on the Fed. You know, rising interest rates in the US means that this amount of money, this liquidity sloshing around the world, will track or go towards the US. That means that the dollar might strengthen, and it means the rand weakens. So that's one of the implications. And the other one is this risk-on, risk-off trade. What does that mean? Well, it just simply means that when people are willing to take more risk, they want more returns, and that typically means emerging markets and currency markets, emerging currencies. When they're a little bit more spooked, or they can see better returns in the perceived safe American market, the money flows to America. So interest rates influence the currencies, and they influence the sort of risk-on-off trade. And what we've been seeing recently, obviously, is the fact that the Fed's gone more dovish means that people expect a slower or less rising rates in the US, and therefore maybe they want to look elsewhere for higher returns, and they come to emerging markets and commodities and the rand, and we see that cycle run, and that's what we're seeing in South Africa. We've seen in the last quarter. That's what's been happening. Let's
speak to Colen about what we're seeing in South Africa in terms of the South African Reserve Bank. We've seen interesting moves coming through from the ECB and the Bank of Japan on those negative interest rates. With us, it doesn't look as though we are following suit, right?
No, definitely not. If I look at the global economy, it looks as though the key central banks are running out of options. And the next phase would be fiscal measures. But I think in South Africa's case, circumstances are somewhat unique. We got the impact of the drought, putting upward pressure on inflation, food prices in particular. And I would argue very strongly that the Reserve Bank ought to sit on its hands and not do anything. It should really be invoking the escape clause, if you can call it that it was given, or the flexibility to the mandate it was given in 2008, which allows it to acknowledge these external factors, which it has no control over, like the drought, like floods, and keep monetary policy on hold. But of course, that's not happening. The Reserve Bank is looking holistically at inflation.
What about the inflation print that came out this week? Wasn't that a little bit better?
It was a bit better, but I don't think that it changes the trend. The trend is up. The base effect, which arose from the March figure last year, that helped the number lower. I think also the campaigning for no fee increases on education, I think that helped as well. That wasn't a contributing factor to inflation. But I think the trend is up. We're over the target. We're probably still going to stretch to 7.0 and beyond for what's left in the year. And of course, that does raise the prospect of further rate hikes at a time when the economy is steering very close to recession, if it's not already in. We'll get those Q1 GDP numbers now at the end of next month. And the first 2 months of the year, those rolling 3-month projections on mining and manufacturing don't look too exciting. They're contractions already. So we're going to close the quarter off with a full contraction of about 23% of our economy. Does that not raise the possibility of recession? But the Reserve Bank is pushing high interest rates, responding to inflation.
It's all about sentiment. So a lot of analysts have been saying emerging markets and the sentiment around that. We've been doing well over the last couple of weeks. Can we sustain that? And from an investment perspective now, if you were underweight, do you now start changing that?
Underweight to South Africa?
Yeah, well, the emerging market basket, yes.
Yeah, look, I suppose we've done an analysis. We try to decompose what drives the rand, and you can use emerging market currencies, I suppose, as a proxy. And we think that there's roughly, in equal weights, what we do to ourselves, in other words, what South Africa, our own policies and the impact of that. Secondly, what the dollar does. And then the third one, especially to commodity emerging market currencies, what commodities do. So the issue of overweight or underweight, the one question is, should South Africans overweight more overseas? Well, we like to beat ourselves up and blame any weakness on the rand, on all these all the mischief of our own making, and we're trying to ignore the fact that, in fact, we're actually just bobbing around on the sea of global capital and global policies, and we're often just the consequence of events outside the country. I think it's incredibly hard in the short term to make a call on the currency and say, okay, well, the rand strengthened somewhat now. Let's go a little bit more overseas and overweight foreign currencies or overweight emerging markets. I mean, right now the trend seems to be our friend. But the fundamentals are that we still, within the third of the drivers that impact us, have a lot of work to do from policy, income inequality, get the economy working. And on the other side is the million-dollar question, and that is what happens to commodities. Is this just a temporary rally in a declining commodity cycle, or are we going to establish some kind of new level for commodity prices? And then the third one we've discussed, and that's the Fed. So I think the short-term level of speculation is quite difficult to get right. At 16, 17 to the dollar, everyone wanted to take their money overseas.
Yes. Yeah.
And that was because it was going to 20. Now suddenly at 14, 30, 14, 20, it's not so obvious. So from a portfolio management perspective, our view is don't try and time the currency. Just make sure you've got a good diversified basket. Assets in South Africa and assets overseas. You are going to get currency timing right wrong.
I want to come to you. I don't know if you've got a comment on what Geoff has just said.
Yeah, I think broadly it's a phenomenon in South Africa that we maybe leave it too late. And when the rand is already bolted out of the stable, so to speak, we realised just hang on, we better diversify some of our assets offshore. So we come in at the tail end of it. But I think the rand strength, to my mind, one's got to raise a lot of questions about it. We've seen since September, in fact, even before the Nenegate issue, foreigners have been selling something like 73 billion rand net in equities. Yeah. They've been buying more recently on the bond market, but I think that's also been encouraged by the successful oversubscription of our $1.25 billion global bond issue. And I think that in itself is maybe underpinning the rand. But I think also some of it has to do with Brazil, the vote to impeach Rousseff last Sunday in the universe of emerging markets. Helped the real, helped by contamination the rand, very positively. But I think one's got to be very mindful of the risk. We still have an element of political risk, which is factored into our downgraded risk assessments, our credit ratings, which come up for review now very, very soon. I don't think that's fully, out of the market's mind, so to speak. But it is interesting to see the switch from equities into bonds. Clearly in the context of global markets, foreigners are saying, okay, we're prepared to take some risk, get the return, and buy South Africa, buy Z8 debt. And that's interesting because the longer term outlook for South Africa, I think, must be good. Right now we question a lot of issues, but I think longer term one's got to be more positive.
I think also it's interesting to note that you talk about appetite for emerging market debt, not just South Africa, but Argentina, who's been out in the cold for 30 years and has defaulted.
Didn't they
absolutely.
have
I think
good appetite?
Their issuance was 4 times oversubscribed.
Absolutely.
Okay. Admittedly, it was on 5. I think the yields were 5% higher than South African yields. Yeah. But that's, there's the risk on is trade is back on.
Absolutely. If you look at the returns, if you're getting the global bond issue was raised at 335 basis points over the US Treasury. So that's a great sweetener. It's straight away to begin with, very cheap. But also the coupon came in at 4.875%, paid semi-annually. You look at G3 interest rates near zero levels, and you've got to be saying, look, I'm prepared to take on a bit more risk. Yeah. Where do I go? I've got to go to an emerging market. Yeah. Where are they? Where are the liquid and deep, bond markets, South Africa?
So just to be clear, are you saying that if we are faced with a downgrade, if it does happen, it seems to be the consensus that it's not a question of if, it's when it does happen. If we're still on risk-on mode, this could still be good news for South Africa. Our bonds, people, investors will still want to buy into them.
Absolutely. I think the latest stats from National Treasury indicate the foreigners hold something like just short of a third, of our bond issuance. So that says something. If the risk appetite to South Africa was negative on a more sustainable basis, a longer term basis, foreigners would be disinvesting tremendously more in the bond market. I can understand their lightening of portfolios in equities, but I can see perfectly what they're doing in hedging themselves against low returns in G3 markets. They're picking up very attractive and very liquid zero debt. They're not encumbered by ex-con. You know, there's mobility of capital.
Yeah.
You know, these are all good things that.
Geoff, I just want to get a very quick closing comment, because can you believe it, we're almost running out of time. We'd like to talk about asset allocation. You spoke about a couple of factors here, a switch from equities to bonds. Right now, what are you saying to your clients?
Look, our view is that our preferred asset class remains equities, even though it's toppish in South Africa and toppish globally. But if you look at fixed income, in cash, you're getting almost nothing. In property, you're getting okay, but it's also toppish. And if you're taking a developed market bond play, you're really looking at negative yield. So you're actually looking at disinflation. And if that's your punt, then go there. But we're not sure that it's going to materialize. So it's probably a bias towards equities, partly driven by the fact that nothing else looks that great.
Final comment from you?
I think I must maybe quote what the Economist said, quite some time ago. It said, trying to forecast a currency like the Rand exchange rate, you'd have more success reading tea leaves. And that's very, very difficult, trying to forecast where the Rand is. I think one's got to take a strategic view. Don't try and second guess the currency. It's not going to work that way. But I somehow get the feeling that once all the negative news is out the way, and the SAB Miller's deal in particular comes into play, and the FDR that may arise from that, one can't be too negative on the Rand for too long. That may materialize in the second half of the year. We see.
Gentlemen, it's been a great pleasure having you in studio today. Absolutely enjoyed the discussion. Thank you so much to Geoff Blount, Managing Director at BayHill Capital, and Colen Garrow, Economist at Lefika Securities.